Starting a new business is an exciting journey, but it's also filled with risks, especially when it comes to managing finances. Many startups struggle financially in their first year due to a combination of inexperience, poor planning, and a lack of financial knowledge. According to various studies, the first year is a critical period, and making the wrong financial decisions can set a business back significantly. In this video, we'll explore the top 10 financial mistakes that startups make in their first year and offer insights on how to avoid them. 1. Underestimating startup costs. One of the biggest mistakes startups make is underestimating the costs involved in launching a business. Many entrepreneurs focus primarily on revenue projections and forget to account for all expenses, including equipment, software, marketing, and employee salaries. This can lead to cash flow problems when unexpected costs arise. To avoid this, it's essential to create a detailed budget that includes both fixed and variable expenses, and to plan for unexpected costs by keeping a buffer fund. 2. Failing to separate personal and business finances. Many new business owners fail to set up separate personal and business accounts. Mixing personal and business finances can lead to confusion, inaccurate financial tracking, and potential tax issues. It also makes it difficult to determine how the business is performing financially. To avoid this mistake, make sure to open a dedicated business bank account and credit card, and use accounting software to separate business transactions from personal ones. This will simplify bookkeeping and provide a clearer picture of your business's financial health. 3. Not tracking cash flow regularly. Cash flow is crucial for the survival of any startup. Yet many new entrepreneurs neglect to track their cash flow regularly. A lack of attention to cash flow can lead to running out of funds, which is one of the leading causes of business failure. Startups should set up regular cash flow reports to track income and expenses and to forecast future cash flow needs. By staying on top of cash flow, you can avoid financial shortfalls and ensure the business has enough liquidity to cover its day-to-day operations. 4. Overestimating revenue and underestimating expenses. Many startups make overly optimistic projections about their revenue, expecting a flood of sales in the first few months. However, it's common for new businesses to experience slower growth in the beginning. At the same time, expenses can be higher than expected due to unforeseen challenges. Startups that overestimate their revenue while underestimating their expenses can find themselves in financial trouble. To prevent this, base your financial projections on realistic data and conservative estimates. It's better to under-promise and over-deliver than the other way around. 5. Neglecting to save for taxes. Entrepreneurs often overlook the importance of saving for taxes, especially in their first year when there's so much else to focus on. In many cases, new business owners are shocked when tax time arrives and they find themselves unprepared. Failing to set aside money for taxes can result in penalties and interest, affecting cash flow and profitability. Set up a separate tax savings account and regularly deposit a percentage of your income to cover your tax obligations. Consider working with an accountant to understand your tax liabilities and to stay compliant. 6. Ignoring financial planning and forecasting. Without proper financial planning and forecasting, startups are flying blind. Failing to plan ahead can lead to missed opportunities and unnecessary risks. Financial planning helps you allocate resources effectively, anticipate cash flow issues, and make data-driven decisions about your business's growth. Startups should create a detailed financial plan that includes income statements, balance sheets, and cash flow projections. Regularly update the plan as your business evolves, and use it as a guide to make strategic financial decisions. 7. Spending too much too soon. Many new business owners make the mistake of overspending in the early stages of their startup. Whether it's on office space, equipment, or marketing campaigns, it's easy to get carried away when funds are available. However, excessive spending can quickly drain your cash reserves, leaving you vulnerable to financial problems. It's essential to prioritize spending based on the most critical needs and to adopt a lean approach in the beginning. Focus on what will generate the most return on investment and defer non-essential expenses until your business is more established. 8. Overhiring too early. Hiring employees is a major expense, and many startups make the mistake of overhiring too soon. In an effort to build a team quickly, New businesses may hire too many people without fully understanding their roles or the cash flow required to support payroll. This can quickly drain resources and increase operational costs. To avoid this mistake, hire strategically. Focus on key positions that will directly impact your ability to grow the business. Consider outsourcing or using contractors for non-core tasks until your business can afford full-time employees. 9. Lack of an emergency fund. Another mistake that many startups make is failing to set up an emergency fund. Emergencies, whether it's an economic downturn, unexpected expenses, or a drop in sales, are inevitable. Without an emergency fund, a startup could struggle to survive during tough times. Financial experts recommend setting aside at least 3 to 6 months' worth of operating expenses in an emergency fund. This will provide a cushion to fall back on if your business faces unexpected challenges and help ensure long-term sustainability. 10. Neglecting to seek professional financial advice. Finally, many startups fail to seek professional financial advice during their first year. As an entrepreneur, you might be focused on growing the business and may not have the expertise to navigate complex financial decisions. Hiring an accountant or financial advisor can help you avoid costly mistakes, optimize tax strategies, and plan for growth. An expert can also help you implement sound financial practices and offer guidance on fundraising, budgeting, and financial forecasting. The first year of a startup is filled with both exciting opportunities and significant financial challenges. Making the right financial decisions early on is crucial for long-term success. By avoiding the common mistakes outlined in this article, such as underestimating costs, failing to track cash flow, overspending, and neglecting financial planning, you can set your business on the right path. With careful planning, strategic decision-making, and professional guidance, your startup can navigate its first year successfully and build a solid financial foundation for future growth.